In the shadowed annals of monetary history, where empires have risen and crumbled upon the unyielding gleam of gold, a profound transformation unfolds in our time. For the first time since the twilight of the classical gold standard, a great power China is methodically relinking its currency to the ancient metal, not through decree, but through relentless accumulation and visionary infrastructure. This is no fleeting debasement trade. It is a deliberate renaissance of money's primal essence. It's a saga that may redefine the architecture of global finance for generations. As we stand here in January 2026, with the echoes of 2025's unprecedented central bank demand still reverberating, this story captivates the imagination like few others in our era. At the epicenter stands the People's Bank of China, the world's preeminent gold purchaser for years running. Throughout the past decade, and especially accelerating in the mid-2020s, it has added hundreds upon hundreds of tons to its vaults. Official reserves are reported around 2,300 tons. But seasoned observers from institutions like Bloomberg Economics, J.P. Morgan, and the World Gold Council estimate the true holdings when including state-controlled banks, sovereign wealth funds, and undisclosed repositories could approach 4,000 to 5,000 tons, or perhaps even more. This silent hoard grows not in isolation, but in deliberate counterpoint to a gradual divestment of U.S. Treasury bonds, subtly eroding the dollar's once unassailable position as the global reserve currency. The spark that ignited this acceleration traces back to 2022, when the United States froze approximately $300 billion of Russia's foreign exchange reserves. In that moment, a veil was torn away. Nations around the world beheld a harsh truth: wealth denominated in dollars, sovereign only until geopolitical winds shift. If even a nuclear-armed power could be so swiftly dispossessed, what fragile illusion of security cloaked the reserves of smaller or less aligned countries? Emerging markets, particularly in the global south, began to stir. Central banks initiated a quiet exodus from U.S. treasuries, redirecting capital toward the timeless sanctuary of physical gold. China's purchases surged visibly after the tariff threats of the late 2010s. But the pace became torrential in the 2020s. Public demonstration to allies and observers alike: we are forging a path beyond dollar dependence. This shift is etched in the ledgers of history. Once, roughly 70% of global reserves reposed in U.S. dollars, considered the safest harbor on Earth. Now that share has dwindled to historic lows, while gold's proportion climbs inexorably. Central banks collectively hold over 36,000 tons, with quarterly demand projections stretching into 2026 and beyond suggesting continued fervor. A pivotal milestone arrived in mid-2025, when updated Basel III regulations reaffirmed physical gold as a zero-risk weight Tier 1 asset. Banks may now recognize its full value on balance sheets, equating it to cash itself. Though it has not yet achieved full high-quality liquid asset HQLA status, the elite tier that permits use in repo markets and short-term financing. This elevation marks gold's resurrection from ornamental relic to active financial instrument. The next ascent toward true HQLA recognition looms on the horizon, promising to unlock gold as collateral in the vast plumbing of global lending, a domain long dominated by U.S. treasuries. Consider the profound implications. Today, a nation seeking to finance ports, power grids, or factories must often pledge treasuries to secure dollar loans through Western-dominated channels. But should gold attain equivalent collateral status, entire economies could flourish independently, free from the gateways and conditionalities of the old order. China has anticipated this evolution with masterful foresight. At the heart of its strategy lies the Shanghai Gold Exchange (SGE), the world's largest physical gold marketplace. Expanded in recent years with new vaults in Hong Kong and plans spanning Asia, the Middle East, and Africa, this network, informally dubbed the Gold Corridor, forms a decentralized chain of secure repositories. Each vault connects to the SGE, tracking every bar with meticulous precision, serial numbers, purity assays, ownership records. It is a modern echo of distributed ledger principles, but anchored in sovereign verified physical metals rather than digital code. This architecture resolves long-standing objections from potential partners. Years ago, when China first urged BRICS nations to settle in yuan, the response was cautious. What truly backs your currency? Gold convertibility was offered, yet the prospect of custody concentrated in Beijing evoked memories of past imbalances. The gold corridor dispels such doubts through geographic dispersion and transparent verification, gold redeemable. Volatility tempered by settlement prices averaged over hundreds of trading days, shielding users from sharp fluctuations. The brilliance deepens here. Resource-rich continents, like Africa, which produce between a quarter and a third of the world's gold. Much of it from artisanal and small-scale miners can now deposit bullion directly into SGE-linked vaults. Exchange through institutions like the New Development Bank, the BRICS alternative to Western lenders. Nations borrow yuan to fund transformative infrastructure, roads slicing through jungles, ports welcoming trade, power plants illuminating. Futures. China secures influence, raw materials, and expanding markets. Partner nations gain autonomy, bypassing the stringent oversight of the IMF or World Bank. A parallel financial realm emerges, gold-anchored, yuan-facilitated, and increasingly self-sustaining. Recent developments hint at further innovation. Pilot discussions around trade settlement instruments, some partially gold-backed, others blending BRICS currencies, suggest the contours of a more formalized system may crystallize in the coming years. The West observes with growing awareness. Reports of the United States repatriating substantial gold holdings from overseas. Vaults in recent years officially tied to audits or trade concerns may mask deeper preparation. With the largest official reserves exceeding 8,000 tons, America positions itself for a world where physical custody confers decisive advantage. In such a landscape, whoever commands tangible gold may shape the financing of the developing world's ascent. For investors, the vista gleams with possibility. Institutional portfolios traditionally allocate around 20% to hard assets like gold. Emerging guidelines from major banks advocate closer to 30%. This seemingly modest shift represents trillions in potential new demand. Unlike fiat currencies, gold's supply cannot be conjured at will. Annual mining adds merely a fraction to above-ground stocks. Sustained inflows could propel prices far beyond current levels, some analysts envisioning doublings over 5 to 10 years. This grand chessboard illuminates past anomalies. The prolonged suppression of gold and Bitcoin prices, even amid inflationary pressures, now appears strategic. Powers amassed positions before allowing ascent. As control consolidates, restraint may ease. What emerges is a historic bifurcation. On one side, China and its allies champion a realm of tangible, timeless, backing physical, deliberate, exerting, measured control. On the other, the United States and Western innovators may counter with the strengths of the digital age. Stablecoins, tokenized real-world assets, perhaps Bitcoin itself programmable, instantaneous, borderless, and transparent. For the first time in the modern era, humanity approaches a multi-monetary dawn. No longer a singular hegemonic standard imposed by circumstance or force, but competing visions of trust itself. Gold embodies endurance through millennia, scarce, immutable, grasped in hand. Digital assets like Bitcoin offer trust forged in mathematics and energy, verifiable by code. It's unstoppable across frontiers. Both paradigms may coexist, each appealing to different temperaments and needs. Nations and individuals could choose or blend their monetary anchors. In this contest of ideas, assets long held in check may reprice with breathtaking speed, not tomorrow, across the sweeping arc of the next decade. This narrative, drawn from the keen observations of thoughtful analysts across finance and geopolitics, unfolds not in frenzy, but with inexorable gravity. We stand at a rare inflection. the very nature of money contested anew, its future shaped by choice rather than decree. As the golden thread weaves onward through history's tapestry, one question lingers: what world shall we inherit, and what role shall we play in its forging?